Introduction to the Financial Markets. In this video, you will learn: what is trading, the Forex market, the equity market, the commodities market, and the derivatives market. The origins of trading date back to prehistoric times. It's been there ever since man started painting symbols on cave walls and realized that in exchange for an arrowhead, he could get paint. Some 10,000 years BC, exchanging cacao leaves for shiny stones was as common as selling cars for money today. Since goods were first exchanged between people thousands of years ago, trading has been a great way of making profits. People started trading everything: real estate, cattle, sugar, cotton, gold, oil, food, clothes, weapons, technology, even art. Today, even trading money for money is possible. Moreover, anyone can do it online, at any time, and from anywhere. The financial market is the place where financial assets such as stocks, bonds, currencies, and commodities are traded. Some people are motivated to trade because they expect to gain a profit on their investment. We call them speculators. Speculators try to anticipate price movements and trade to make a profit by buying low and selling high. Some other people are motivated to trade in order to manage their risk. We call them hedgers. Hedgers trade in order to protect an asset they already have, like the farmer who sells his crop before the harvest season. Besides trading to save, manage risk, and speculate, some people trade simply because they find it challenging. Financial trading all over the world takes place either through a regulated centralized exchange or over-the-counter. Exchange-traded markets operate via a centralized exchange, such as a stock exchange or futures exchange like the New York Stock Exchange, NYSE, the London Stock Exchange, LSE, the Tokyo Stock Exchange, TSE, and many more around the world. Over-the-counter markets are decentralized markets made up of networks of different dealers who compete to link buyers to sellers. In an over-the-counter market, dealers act as market makers by quoting prices at which they will buy and sell a security or currency. In addition to being traded, or OTC, financial markets are also categorized based on the type of security traded, such as the foreign exchange, or Forex market, where you can buy and sell currencies like the euro and the dollar. The equity, or stock market, where you can buy and sell shares of companies like Apple, Facebook, and Alibaba. The commodities market, where you can buy and sell commodities like gold, oil, grains, sugar, and even frozen concentrated orange juice. The bond, or fixed income market, where you can lend money to governments or corporations. The derivatives market, where you can trade financial contracts that obtain their value from an underlying asset, like the above four. The foreign exchange market, or Forex market, is the financial market where currencies are traded or exchanged for one another. It is the biggest market in the world, with an average volume exceeding $5 trillion per day, and is open 24 hours a day, 5 days a week, from Monday to Friday. The foreign exchange market is an over-the-counter market used by individuals, financial institutions, businesses, governments, and other agencies. Foreign exchange transactions occur because of international trade, tourism, borrowing and lending, and speculation. Today, most currencies are freely floating, and their price is determined based on the demand and supply of each currency. The equity market, or share market, is simply the place where shares or stocks are traded. As their name implies, shares are financial assets that provide evidence of ownership in a company, and hence a share in its profits. Shares of publicly listed companies like Apple and IBM are traded in a stock exchange like the New York Stock Exchange. If the company is profitable at the moment and expected to make more profits in the future, the price of the share will rise as more people will want to own part of this company. If the company is not profitable at the moment and is not expected to make future profits, its share price will drop, as people will not want to own that company, but will prefer another. The commodities market is the place where raw materials instead of manufactured goods are traded. They are divided into three main sectors: agricultural commodities. These include grains, food, and fiber like corn, soybeans, and cotton, but also livestock and meat like cattle. Energy commodities: crude oil, Brent oil, ethanol, natural gas, and propane. Metal commodities: industrial metals like copper, lead, and zinc, and of course precious metals like gold and silver. The bond market, or fixed income market, is the place where investors and traders trade debt securities. It is the market where borrowers that have shortage of cash meet with investors that have surplus of cash. The main issuers of bonds are governments, semi-government institutions like municipalities, and corporations like IBM. Debt securities can be as simple as a bank loan, a government bond, a corporate bond, as well as other securities. When you buy a bond, you are lending the issuer money, and they promise to pay you back in full with interest in the future. A city may sell bonds to raise money in order to build a bridge, while a company like American Airlines may issue bonds to buy new aircrafts. A derivative is an instrument whose value depends on or is derived from the value of some other instrument, called the underlying asset. For example, oil derivatives derive their value from the value of oil in the oil market. Derivatives are divided into two categories based on the asset they derive their value from. Commodity derivatives are based on commodities. Energy contracts derive their value from energy commodities like oil and gas. Financial derivatives are based on financial instruments. Stock and index contracts derive their value from the underlying stock or index. There are several types of derivatives, with the most common being futures, options, and contracts for differences, CFD. Futures: a standardized contract to buy or sell an asset at a predetermined price, at a specified date in the future. Options: a contract that gives the holder the right to buy, call option, or sell, put option, a security at a specified price. Contract for difference, CFD, a derivative contract used as a speculative tool against changes in the value of an underlying asset. Financial derivatives have many benefits, such as margin trading, going long and short, and some of them being tax-exempted. Margin trading, however, as in all cases, can increase both the profit potential but also the risk, so traders must use them wisely and should always remember the most fundamental rule of investing: the higher the risk, the higher the return. In our next video, we will talk about Forex. Thank you for watching.